There are several factors that can contribute to why some stocks are cheap while others are expensive. Here are some possible reasons. 1. Supply and demand. The price of a stock is determined by the interactions of many buyers and sellers in the market. When there are more buyers than sellers, the demand is high, and the price tends to rise. Conversely, when there are more sellers than buyers, the supply is high, and the price tends to fall. 2. Earnings and revenue growth. Companies that consistently demonstrate high growth rates in their earnings and revenue are often considered more attractive to investors. As a result, their stock prices tend to be higher. Investors are willing to pay more for companies that are growing rapidly and have a strong track record of success. 3. Valuation ratios. Valuation ratios, such as the price-to-earnings (PE) ratio and price-to-book (PB) ratio, help investors determine if a stock is overvalued or undervalued. A high PE ratio might indicate that a stock is expensive, while a low PE ratio might suggest it's cheap. Similarly, a high PB ratio might indicate that a stock is overvalued, while a low PB ratio might suggest it's undervalued. 4. Industry and sector performance. Companies in growing industries or sectors tend to have higher stock prices due to their potential for future growth. For example, companies in the technology sector might have higher stock prices due to the growing demand for digital products and services. On the other hand, companies in declining industries might have lower stock prices due to decreased demand and revenue. 5. Company performance and health. Investors tend to pay more for companies with strong financials, e.g., high profit margins, low debt. Competitive advantages, e.g., patents, brand recognition. Good management, e.g., experienced leaders, successful track record. High returns on equity (ROE) and assets (ROA). Low debt-to-equity ratios. Conversely, companies with poor financials, declining revenue, or weak management might have lower stock prices. 1. Market sentiment and investor sentiment. Market sentiment refers to the overall attitude of investors towards the market or a particular stock. If investors are optimistic about a company's future, they might be willing to pay more for its stock, driving up the price. Conversely, if investors are pessimistic, they might sell their shares, driving down the price. 2. Economic indicators and macroeconomic trends. Macroeconomic factors, such as interest rates. High rates can make borrowing more expensive, hurting companies. Inflation. High inflation can erode purchasing power, hurting companies. GDP growth. Slow growth can indicate a weak economy, hurting companies. Unemployment rates. High unemployment can indicate a weak economy, hurting companies. Can impact stock prices. For example, if interest rates rise, companies with high debt levels might see their stock prices fall. 3. Short-term market fluctuations. Stock prices can be affected by short-term market volatility, news events, and other temporary factors, such as news headlines, e.g., political events, natural disasters, analyst upgrades or downgrades, earnings announcements, economic data releases. These factors can cause stock prices to fluctuate rapidly, even if the company's fundamentals haven't changed. Keep in mind that these factors can interact with each other in complex ways, and there may be other reasons why some stocks are cheap or expensive. It's always important to do your own research and consider multiple perspectives before making investment decisions.